You know, every single day, millions of tons of goods are moving silently across North America. They're powering our lives in ways we probably don't even think about. So today, we're going to pull back the curtain on one of the quiet giants of this hidden world, the Canadian National Railway.
So what is this invisible force I'm talking about? Now, you might be thinking the internet, or maybe the power grid, and yeah, those are absolutely vital. But I'm talking about something even more fundamental, something physical that keeps our entire economic engine humming along.
That's right. It's this massive, sprawling, and totally essential network of railways. And we're going to focus on one of the true titans of that network, Canadian National, or CN, to really understand how it works and, more importantly, why it's so incredibly dominant.
All right, first things first, let's get a handle on the sheer scale of this operation. Because what makes CN so special isn't just its size, it's where its tracks are. Its geography gives it this incredible, powerful advantage over pretty much everyone else.
Just look at this map. CN's network creates this massive Y shape across the continent, and that shape is its secret weapon. Get this, it is the only railroad in all of North America that touches 3 different coasts: the Atlantic, the Pacific, and the Gulf of Mexico. That kind of access to global markets is just unheard of.
So what's actually moving on all these rails? Well, it's a bit of everything, which is smart business. You've got intermodal containers, those big boxes you see on ships and trucks that carry everything from your new phone to your clothes. But they also haul the really heavy stuff, the raw materials that literally build our cities and feed the world, like grain, chemicals, and minerals. Being this diversified is huge, because it means a slump in one industry doesn't sink the whole ship.
Okay, so this brings us to a really crucial idea if you want to understand a company like CN. It's all about its competitive advantage, what analysts call an economic moat. And let me tell you, this is the exact reason these railway giants are so difficult to compete with.
Think of it just like a real moat, the water-filled ditch protecting a castle. For a company, this moat is some kind of powerful, long-lasting advantage that keeps all the competitors out. And for a railroad like CN, that moat is incredibly wide and deep, and it's built on 2 main things.
The first part of that moat, a massive cost advantage. I mean, look at this comparison to trucking, which is really their main competition. Rail is about 4 times more fuel efficient. And that efficiency means they can offer prices that are 10 to 30% cheaper on those long-haul routes. It's just simple economics. If you need to move a lot of heavy stuff over a long distance, nothing beats a train.
And the second part of that moat is what analysts call efficient scale. Honestly, this quote from Morningstar says it all. The network is essentially impossible to replicate. I mean, just think about it. Could you imagine trying to build a brand new, competing 20,000-mile railway today? The cost would be insane, the regulations would be a nightmare, and you'd be starting from scratch with no customers. It is a massive, almost perfect barrier to entry. So how did we even get here with these impossible-to-replicate networks? Well, it's a story of consolidation. Back in 1980, after the industry was deregulated, a frenzy of mergers began. We went from having over 40 major railroads down to just 7 giants today. This basically created a market where, in most places, if you want to ship by rail, you've only got 1 or 2 choices. And that, right there, gives these railroads incredible pricing power. Okay, so we get it. CN is in a really powerful position. Now let's talk about how all of this builds into what investors call the bull case. Basically, all the arguments for why the company's future looks really bright.
The bulls, the optimists, they're pointing to a few key things. First, long-term trends like highway congestion and the high cost of fuel are pushing more and more shippers to move freight from trucks onto trains. Inside the company, CN is doubling down on this super efficient model called precision scheduled railroading, which is all about running trains on a tight, reliable schedule to cut costs. And don't forget, they have exclusive rail access to the port of Prince Rupert, which is a booming gateway for trade with Asia. At the end of the day, these businesses are just absolute cash-generating machines.
But, of course, it's not all clear sailing, or a clear track ahead. There are some pretty significant risks to think about, which brings us to the other side of the coin, the bear case. This is the argument for being a little more cautious. So what are the bears worried about? Well, for one, railroads are completely tied to the health of the broader economy. Things like tariffs or a recession can hit freight volumes hard. At the same time, the trucking industry is always a competitor, and when they have a lot of extra trucks available, they can cut prices and put the squeeze on the railroads. And then you have the external risks that are always lurking. the possibility of new government regulations, and as we saw in 2024, the very real threat that labor disputes can bring the entire network to a grinding halt. So you've got the bull case and you've got the bear case. You have these two totally competing stories. So how does an analyst take all of that, weigh the good against the bad, and come up with a single number for what the company is actually worth?
Well, this is how they do it. This chart might look a little technical, but the idea is actually super simple. They run all the numbers through a complex model to generate a fair value estimate. That's the analyst's best guess at the company's true intrinsic worth. The other line, that's the actual stock price on any given day. So whenever that stock price dips below the fair value line, the analyst sees it as potentially undervalued. So let's make this real. On November 3rd, 2025, the market decided that one share of Canadian National was worth $134.40. That was the price.
But, and this is the key part, after the analyst weighed all those pros and cons we just talked about, their fair value estimate came in higher at $147. What that suggests is that in their view, the market was maybe being a little too pessimistic about the company's long-term value at that moment. And you always want to ask, okay, but how does that compare to its peers? You can see here that its price-to-earnings ratio, which is a really common way to measure value, is actually lower than its main Canadian rival, CP, and also lower than CSX in the US. This suggests it's not trading at a crazy premium compared to what it earns. That kind of sanity check against the competition is absolutely critical.
And all of this brings us to our final thought. I mean, Canadian National is a legacy business, right? It's an industrial giant with a competitive moat that's almost impossible to cross. But it's also operating in a world that's facing huge economic uncertainty, incredible technological change, and a massive focus on environmental impact. So the real question is, for a company that was literally built on steel and diesel, how does it keep chugging along and thriving in a world that is changing faster than ever?